Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 1 of Understanding Efficiency Ratios, the financial analysis key. Ever wonder how well a company uses its resources to generate profits? That's where efficiency ratios come in. These financial metrics are crucial for understanding a company's operational performance. By looking at measures like inventory turnover and asset utilization, you can get a clear picture of how efficiently a business is running. Whether you're a seasoned investor or a curious newcomer, understanding efficiency ratios can help you make smarter financial decisions. What are efficiency ratios? Efficiency ratios are like the scorecards for how well a business is using its resources. Imagine you're playing a video game and you want to know how efficiently you're leveling up. Just like that, businesses use these ratios to measure how well they're using their assets to generate income. They give you a peek into the engine room of a company's operations, helping you see how slickly they run. Defining efficiency ratios. Efficiency ratios are mathematical calculations used by businesses to understand how effectively they're using their operations, assets, and resources. They aren't just numbers, they're insights into how well a company is doing at its core tasks. The goal is to keep costs low while keeping productivity high. Think of them as a magnifying glass, zeroing in on specific parts of a business to ensure everything is running smoothly and nothing is wasted. Role in assessing business performance. Why do businesses care about these ratios? Well, they provide critical answers. Efficiency ratios focus on areas like inventory management and credit handling. They show us whether a company has too much money locked in stock or if it's taking too long to pay its own bills. By paying attention to these details, businesses can fine-tune their operations. Here are some key ways in which efficiency ratios impact business performance. Improved decision-making. When businesses know how efficiently they're operating, they can make better decisions about where to cut costs or where to invest more resources. Competitive edge. Companies with better efficiency ratios might have a leg up on the competition. They can offer lower prices or higher quality products because they manage resources better. Financial health indicator. Efficiency ratios can act like an alarm bell. Poor ratios might indicate deeper issues, signaling the need for strategic changes before problems grow. Understanding efficiency ratios is a bit like learning the rules of a game. Once you know how they work, you can see whether you're playing well or need to adjust your strategy. Businesses rely on these numbers to help them stay on track and move towards success with confidence. Types of efficiency ratios. Efficiency ratios are like a health checkup for a business. They're used to figure out how well a company uses its resources to generate sales and profits. By examining these ratios, investors and management can spot where a company is doing well or where it might need improvement. Let's dive into some key types of efficiency ratios to understand what they reveal about a company's performance. Asset turnover ratio. The asset turnover ratio measures how efficiently a company can use its assets to generate revenue. You calculate it by taking the company's total revenue and dividing it by its average total assets. Text. Asset turnover ratio. Eads als frac. Text. Total revenue. Als text. Average total assets. A higher ratio suggests that the company is using its assets effectively to produce more sales. Picture it like a high-speed train consistently delivering passengers to their destinations. If it's running smoothly and efficiently, more riders can get on board. Inventory turnover ratio. The inventory turnover ratio tells you how quickly a company sells through its inventory and replenishes it over a period. To find it, divide the cost of goods sold, COGS, by the average inventory. Text. Inventory turnover ratio. is frac. Text. Cost of goods sold. Text. Average inventory. A high inventory turnover ratio indicates good inventory management, meaning the company is selling its products rapidly. It's like a restaurant where fresh ingredients fly off the shelves, ensuring customers always get the freshest meals. Receivables turnover ratio. This ratio defines how efficiently a company collects debts from its customers, calculated by dividing net credit sales by the average accounts receivable. Hatred text. Receivables. Turnover ratio. Ishamfrak. Text. Net credit sales. Sam text. Average accounts receivable. A higher ratio means the company collects its receivables quickly, which is crucial for maintaining healthy cash flow. Think of it as a game of tag, where the faster you catch your opponent, the better you play. Payables turnover ratio. The payables turnover ratio reveals how quickly a company pays off its suppliers. It is calculated by dividing total supplier purchases by the average accounts payable. Text. Payables turnover ratio equal +frac. And text. Total supplier purchases. Text. Average accounts payable. A lower ratio might suggest the company is taking longer to pay its bills, which could affect its relationships with vendors. Imagine paying back a loan. It's often better to pay punctually to avoid strained relations and extra interest. Total asset turnover ratio. Though similar to the asset turnover ratio, the total asset turnover ratio focuses more broadly on how well a company utilizes all its assets to generate revenue. You calculate it by dividing net sales by the total assets. Text. Total asset turnover ratio. AB. Frac. Text. Net sales. Text. Total assets. A high total asset turnover ratio signifies superior overall asset efficiency, one of the key indicators that a company is making the most out of its resources. Imagine a gardener using every bit of sunlight, water and soil to grow a thriving garden. Understanding these ratios can give you a clearer picture of a company's operational efficiency. They serve as critical tools in assessing how well a business is performing and where there might be room for improvement. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like and share to continue your journey to financial success.